Well, the Federal Reserve decided not to tighten monetary policy any further at its latest meeting. That's despite sticky inflation. While the Fed hasn't raised rates since July, they are at 22-year highs. While consumers continue to spend, their savings are dwindling fast. Yahoo Finance executive editor Brian Sozzi sat down with JPMorgan Chase CEO Jamie Dimon, and he shared what the bank is seeing from its customers. Let's listen.
If this was the average checking account, and make believe it's all one consumer, all that money, at one point they had multiples of what they had pre-COVID. That money is being spent down. If you look at that, what I just said, but you look at the lower, there are different ways of looking at it, it's hard to tell, and some inflation adjusts and some don't, but it looks like the lower, call it the third, is back to where it was pre-COVID. They don't have excess savings anymore, and that the middle class is getting close to zero, no excess savings.
So how else are high interest rates impacting your everyday finances? Well, I'm joined now by our very own Jennifer Schonberger. So Jennifer, what impact are these rates having?
Good morning, Rochelle. The Federal Reserve's decision Wednesday to continue holding interest rates steady is giving borrowers a break for potentially even higher interest rates while helping savers continue to earn more on their money. But the Federal Reserve certainly kept the door open to potentially even higher interest rates. In general, higher rates are hurting consumers' buying power. Homes are much more expensive with nearly 8% mortgage rates now. Financing for auto loans, credit cards, and personal loans are all up and more expensive. Banks are also becoming more selective in who they will lend to. But higher rates also mean earning more on savings in money market funds, which can juice savings and spending. Consumers are earning 4 to 5% investing in short-term money market funds that can support consumer spending at a time when excess savings is being drawn down. Chatting with James Fishback this morning, founder and chief investment officer of Azoria Partners, he told me consumers are being enriched by higher rates. He says the consumer is earning $1.8 trillion a year in interest income. In the last year, he says you've seen an increase of $600 billion just from the consumer going into money market funds that pay out higher rates of interest. He went on to say that while excess savings are being drawn down, that doesn't mean savings is going to zero, and that there's nearly $700 billion in savings in the economy right now, a cash cushion growing at 5% a year if it's in a money market fund. Now, if the Federal Reserve were to raise rates higher, something that JPMorgan Chase CEO Jamie Dimon told our Brian Sozzi last night shouldn't be ruled out, that would mean better news for savers, but could hurt borrowers more, especially those first-time home buyers that could see even higher mortgage rates than 8%. Rochelle?